Today, we have a dose of alpha. Today on the podcast, we got Mike from RedStone. Mike, how are you?
It's so nice to see you, Bryan. So nice to see you, Eric.
What is it that the institutions truly want? What are we missing?
To me, it's a question that nobody really has like a single answers for. One thing that comes to mind immediately is risk assessment, right? One of the reasons why we acquired Credora is exactly because of that.
One of the ugly truths about DeFi is that it's too efficient to the point where there's not enough margin to guarantee good work around the edges.
I will be the most bullish on RWA.
Okay.
To me, RWA is not even a question of being bullish or bearish. It's just happening, and it's something that everyone is seeing.
But when we did the analysis, their liquidity was paper thin. Cool, you want $100 million of borrow capacity. That's great. Your liquidity is $5 million on chain.
This is a real problem. Everyone talks about tokenization, everyone talks about institution, everyone talks about real world assets. If you are in the crypto space, in the crypto Twitter conferences, those are the hot topics. RWA is definitely the most bullish. I think it's something that will be the future of finance.
Mike, how are you? You want to give the audience a little bit of an intro?
It's so nice to see you, Bryan. So nice to see you, Eric. Always happy to be here at the Alpha Growth Podcast. We've been, as you said, knowing each other for a minute now, and we also been working together for a minute. I'm keen to talk about the latest thing that we've been up to in RedStone, in Credora, but also together with Alpha Growth.
That's awesome, dude. Okay, so you're at RedStone. You guys started as the price oracles, but you're kind of like, your narrative is a little bit changing. You're growing. You're like, so what is RedStone today?
We're still an oracle, and price feeds in DeFi and in Web3 are just as important as they were. The thing that changed is that they're not quite enough anymore. Once you start tokenizing, once you start with institution coming to DeFi, you need so much more than just secure and reliable price feeds. So we still provide that, and it's still been a spotless track record of no mispricing event, no downtime since we went live. So we're very proud of it. But we also figured out that that's not going to cut it. In 2026, what these people want, what institutions want, what retail investors want, and also what I want as someone that has been building in Web3 is to have a stack of different products. They all work together to solve a problem. So we started this journey some time ago, as you know, as we talked about it in the podcast, about a year ago, almost to the day, with OEV to recapture liquidation, MEV that leaks out of liquidations in lending protocols. But then we expanded much more. We went into HIP-3 feeds. We went into RedStone Live, which are our high performance feed, into risk, into liquidation specifically for RWA. So we expanded into what we now call the RedStone Stack. And the objective of the RedStone Stack is to provide a one-stop shop for asset issuer, risk curators such as yourself, for tokenization platform, for chains, to solve multiple problems across DeFi and institution fi, or like what is the TradFi coming into DeFi, without having to go to the hassle of doing multiple procurements or multiple due diligences or going through multiple vendors where something goes wrong.
So Mike, what is it that the institutions truly want? What are we missing? And how is RedStone filling that gap?
It's a very good question. And to me, it's a question that nobody really has like a single answers for. There's a many things. One thing that comes to mind immediately is risk assessment, right? One of the reasons why we acquired Credora is exactly because of that. In crypto, we focused a lot on yield for the longest time, since basically DeFi Summer, even before DeFi Summer, we focused a lot on yield. But in TradFi, yield and risk are two sides of the same metal. So we didn't really think too much about the risk. And now institutions, they're very used to think about risk. So they want to see that. The other thing is ease of use. Crypto has always been a very high entry level field where you have to be, even to be an investor, you have to be somewhat technical. You have to understand technical concept. And some of these institutional people, they are financial people. So they know much more for example, than me, definitely, but for the many crypto native about finance, and they know about that type of the business, but they don't know a lot about the technical. So for us,
That's right.
it's very important to provide a good user experience so that they don't have to think too much about slippage and which chain and which wallet to use and all of these kind of moving parts, but they have like a simple way, for example, to trade on chain or to tokenize stuff on chain. And the other thing I think to me is obviously the compliance and the regulatory profile of these institutions is definitely one level above what we're used to. And therefore, every time that they onboard a new vendor, they have to go through the process of onboarding someone new. And that it means potentially months of procurement, which is something that we are aiming to solve, for example, by providing multiple aspects of the RedStone Stack as a single platform. And finally, I will say the last thing is, speed. Like one of the reasons why these people are moving to chain is because in TradFi, you don't have access to the same, for example, settlement time that you have on chain. You don't have access to the same global remittance that you have on chain. And we are providing that with a product that we're going to talk about today, which we call RedStone Settle. And I think that that's one of the missing pieces that solves a key problem that RWA asset issuers have on chain.
Our audience here is very, very technical, very in the crypto industry. We're not doing a beginners podcast. That said, we do have a wide variety of the ecosystem covered, both in guests and in listeners. And so we're obviously going to use a lot of jargon, but we do like to break it down a little bit. We've been talking for a year and a half, at least for me with you, and loved getting into OEV before it was kind of common, but still a lot of people maybe heard of MEV, didn't understand how it jumped to OEV. Can you give a breakdown of Oracle Extractable Value, where we saw it starting and where you see it going now?
Yeah, let's start, I think, with the problem. The problem is something that in crypto has been a thing since the beginning of liquidations. Right? Whenever there is a lending protocol position and that position gets liquidated, what effectively happens is that there is a swap of value, right? So the collateral gets swapped for the principal, and this operation is performed by what we always called MEV bots, which are these bots that effectively perform this liquidation, and they pocket what is called a liquidation bonus, like the effectively slippage that there is between the two transactions. And the main problem of this is that the MEV leaks out of the protocol. The user doesn't get it, the protocol doesn't get it. It's just leaked value that gets lost. And OEV brings that problem into the Oracle. So instead of being a post-action thing, the MEV gets recaptured in the Oracle. The way that it works technically is by running an off-chain auction whenever the Oracle sees the price update. So the Oracle obviously knows if a price is going to change before everyone else. We notify the price update, and we see that can cause a liquidation. At that point, an auction runs, and the liquidators, instead of bidding for gas on chain and just trying to front run each other, they bid in the auction. So for them, it's a very similar experience, with the difference that we then stack rank the bids in the auction, and we send in a single atomic transaction the price update and the auction result onto the chain so that the liquidation can happen in the same block, in the exact same transaction. So it's a zero delay liquidation at the same time as the Oracle update. The result of this is that we recapture this value, this part of this liquidation bonus, and we give it back to the protocol. And then at that point, the protocol or the curator decides to invest it wherever.
We've had this conversation before on a podcast, like a year and a half ago. I think the issue that I always struggle with, or the mentality is a protocol supposed to almost get to this weird point where it's almost like incentivizing liquidations? Obviously, it makes more money on liquidations. If it's a protocol, it may not want. You could say from some standpoint, it's ideal if there's no liquidations as a protocol, but that's how you make money. So is a protocol a business, or is a protocol not a business? Should it incentivize further risk and further liquidations, especially if it's protected by something like OEV or not? I think that's like a really philosophical conversation that we had at the beginning of the OEV discovery. But what it's settled now is you take the money.
I remember that conversation. It was about a year ago. I was not in RedStone a year and a half ago, funnily enough. But yeah, so the interesting part of that is that my answer is the same as it was. So no, I don't think that protocol should be making money out of this. That's not my preferred stance. And liquidation is something that happens, like it happens in every protocol. And MEV, it's just value that gets not captured anywhere else. Like you're not taking anything away from the user. This is just something that before it was just leaking out and now is being recaptured. So the objective of this in the long run is for MEV to go to zero, right? Obviously. So that's what we really want. But now by recapturing it, you're giving the protocols and the curators an opportunity to reinvest that into the markets or into the protocol itself. So ultimately it benefits the user. For the user, there's really no impact, like the situation is the same. Obviously, the protocol now makes money, or the curator makes money where before they were not. But what we've been seeing with the curators and the protocols that we've been partnering with on this is that most of them, if not all of them, are actually putting that value back into the protocol and into the market. So at the time, this was a concern, and it was something that we were discussing. I think that now the history told us that this most of the time, if not all the time.
One of the ugly truths about DeFi is that it's too efficient to the point where there's not enough margin to guarantee good work around the edges. Curators largely don't make enough compared to what TradFi counterparts would because of how efficient it is from lendee to borrower. In doing so, then you trust these risk curators who are allegedly doing all this risk, and then these October 10th events happen and a bunch of things cascade, and they're like, crap, well, my bad. But realistically, a lot of the curators aren't doing real risk provision. They're not even really getting paid that much to do it. It just justifies their AUM. They can raise money separately for the risk that they're verifying. And we do work both on-chain and with TradFi counterparts. And what we see a lot from the TradFi, the real business, as we're working to bring it on-chain, is that they want insurance, they want to take out loans against their stock or whatever it is, and they want the grace of hey, if we get under LTV, call me, give me 3 days to top up, don't just instantly liquidate. But crypto happens same block. And so what we've seen from the TradFi side is what you guys are building is enabling us to bring more of the TradFi business on chain, because we're able to package this and sell this as insurance. This is your grace period. One, for the risk on people, we can raise your risk tolerance because we're more okay with the liquidations now. It's less detrimental. But two, now we can give this, say 90% guarantee or whatever it ends up being, saying that hey, in your worst case scenario, it's really not a bad case, and give this trust that they haven't had available before.
Yeah, I agree. And this connects very well with the conversation that we were having minutes ago about risk. Right? So what you're describing here effectively is these people want to understand the risk, right? And you raise a good point. So some of the curators, they don't really look at all these indicators. They don't really do as good of a job as what you said. But to me, the same thing happens in TradFi. This is not a new thing that is exclusive to crypto. In TradFi, you had risk assessment and independent risk assessment for decades now. And this is something that just now we're seeing in crypto. We acquired Credora in September 2025.
That's awesome.
And one of the reasons why we did this is exactly this, to bring independent risk ratings to DeFi. All the curators that I work with, to be honest with you, they're all great people. And they're all people that they do their homework and they caring about the markets that they put on. The problem to me is not malice. The problem is, events like that, the 10th of October can happen. And it's good for investors to know how risky or safe certain investments are. And then each one of them is going to make up their mind. Obviously, a riskier investment most of the time equates to a higher APY, right? But this is the same thing that happens in traditional finance. So to me, that transparency and that information is step zero. And then each investor will make up their mind based on their risk profile.
All right, we're going to throw a little curveball in here. Mike, this has been awesome so far. This is a question I've been asking recently to a bunch of guests. The F, Marry, Kill type of thing. You ever know that question? Okay, so I got these. All right, so this is we'll go bearish, medium, bullish, right? Mm-hmm. on this stack. So there's a couple narratives that are coming out. These narratives are somewhat some of these have been tried again in the past. They're coming back in vogue again. All right, the first one is AI. The second one is the DeFi Mullet, and the third one is RWAs. If you had to sort rank them, bullish to bearish, how would you sort rank them? What are you most excited about?
I am gonna give you a somewhat maybe controversial answer.
Okay, cool.
I will be the most bullish on RWA.
Okay.
To me, RWA is not even a question of being bullish or bearish. It's just happening, and it's something that everyone is seeing. This question would have made a lot of sense maybe 2 years ago or a year and a half ago, when a lot of people were still talking about block time. Now nobody talks about block time anymore. Everyone talks about tokenization. Everyone talks about institution. Everyone talks about real world assets. If you are in the crypto space, in the crypto Twitter conferences, those are the hot topics. So to me, out of the three, RWA is definitely the most bullish. I think it's something that will be the future of finance. And I always say this is a little bit of my catchphrase now, that I dream of a world where there's no, on-chain finance and off-chain finance. It's just finance. And then the chain is
DeFi, no DeFi, just Fi.
Right, exactly. And then the chain is the infrastructure that powers certain aspect of finance, or if not most aspect of finance, hopefully eventually. So that to me is the most bullish for sure. Second place, I will put DeFi Mullet, and I will say medium on DeFi Mullet. I do like the idea. I think we're a bit early there in terms of how the infrastructure is being built and like what are the adoption around this. But being early doesn't mean being bad. Being early means being early. So DeFi Mullet, I think, in this like crossover between fintech interfaces and decentralized backend that we're seeing, again, it's something that a lot of very smart people are pushing for, and people that are much smarter than me, they really put a lot of eggs into this basket. So I am medium bullish on that. I think that is not as strong today as a narrative as RWA is, but it's definitely has the possibility and the potential to be strong.
So we're going to kill the AI.
We're going to kill the AI for now. I do think that we are not yet in the position where we can offload important financial decision to AI models.
Okay.
That's just basically, to me, the reality of thing. Hallucination is still a thing. It's been improving a lot, and AI has been going much better. And I'm very impressed by the speed at which AI is improving and is growing. But out of the three, it is the least real today for me.
Interesting.
I don't see AI making the same type of impact in crypto or even in DeFi as RWA are making.
I'm really surprised at that. I think, I don't know what my stance would be. But I think what's really interesting is that in your stance, like RWAs are here. And I know there's like some of the stuff that they're working on. I want to tell a little bit of story about the RWA. So we were, running all of like the BD at Compound, and a gold token came, like one of the two largest ones. And we had a conversation with both of them, but one was like really excited to launch and get on Compound and get a listing and everything. But when we did the analysis, their liquidity was paper thin. Mm-hmm. And we were like, cool, you want $100 million of borrow capacity. That's great. Your liquidity is $5 million on chain. Like, they're like, oh, but we guarantee it, and we have the BIPs, and we have the attestations, and we have the paper contracts. Is like, we can't do that. Like, if you go bust, all of the people that are supplying like dollars and ETH, our job is to at risk. And I think this is a good like segue. Like, you're bullish on RWAs, on how we started the conversation on the liquidation vault, because what we basically kind of said to them was like, okay, you got to bring the liquidity on chain. And they're like, well, what if we like atomically redeem? And then I was like, okay, well, how do we redeem to cash? They said the biggest window would be 4 days, right? In a bank holiday weekend, or there's a 2-day weekend, the longest possible redemption to cash would be 4 days. And so you have this like 4-day window to take the gold token, redeem the gold token, 100 million, 200 million. They could do 200 million, up to 200 million in like 72 hours, right? Like 100 million in 24 hours. So we had a problem. with these RWAs. And the problem was, if the liquidity isn't on chain in depth and size, how can you protect that lending and that credit risk? And so we started a conversation with you guys around something that we have launched. Do you want to talk about that?
I do, and this is a real problem. And 4 days is not even too bad, to be honest. Like, there is a lot of RWAs that have much bigger and longer redemption windows. And sometimes it's not even a number of days. Sometimes you just can redeem it in a specific time. Right? So depends on like when the liquidation happened or needs to happen, then you can wait undetermined amount of time, which is not good. What we are used to in crypto, as Eric was saying before, is precision and speed. and we need to make sure that we provide that. So we launched this, we've been talking about it internally between the two of us and with Symbiotic as well for quite a while. But the product that we created to solve that problem is called RedStone Settle. And it's called Settle because allows positions to be settled T0 on liquidations event on RWA, even if the RWA redemption time is longer. The way that it came to mind was exactly when I was having one of this conversation with friends in Argentina. We were at DevCon last year. And then, I started thinking about it a bit more, and then went to our technical team, then went across the road to Symbiotic and say, okay, can you guys provide liquidity for this? Is this something interesting for you? And eventually, here we are about 6 months later, and this is a reality. I think that I'm a bit biased, of course, because this is a product that I consider to be a little bit of like our baby when it comes to RedStone. But the way that it works, I think, is quite fascinating. It's very similar to like Atom when it comes to the auction. So there's still an auction that happens off chain, but it's different. So instead of people bidding for higher, liquidation bonus, and like they bid for like a higher ticket to liquidate the position, what happens here is that if an RWA position is to be liquidated, here the solvers, they bid for a discount. So let's say that there's three of us in the same auction. We need to liquidate 100% of a specific RWA position, and then Bryan bids 95, Eric bids 96.5, and I bid 97%. So I win the auction because I liquidate as close as possible to 100%. And what happens is that the position gets immediately settled at T0 against our launch partner is Symbiotic, so Symbiotic Ethereum, but eventually the infrastructure supports any sort of asset on the liquidation on a whitelist basis, of course. And I, as a settler, wait for the redemption time, the famous 4 days, for example, take on that risk and effectively liquidate 100% of the position. So the fee becomes the discount on the liquidation, but on the other hand, you prevent potential bad debt, you get immediate liquidity on RWA position, and you solve for the asset issuers and also for the curator what we all discuss in this 30 minutes is probably the biggest problem around RWA, which is the instant settlement and reducing that type of risk, that type of settlement.
And this is an absolutely huge deal, like a massive unlock for crypto. It makes sense that you're going to come in here and say that, RWAs is the most bullish thing because you're coming here talking about the solution that unlocks it. We've had other guests. We'll put together like a list of what the different guests are saying as their answers, but usually RWA is not the top, and they're like, it's constricted. It's not really coming on chain. Liquidity's not really good enough. It's not really fast enough. Well, now it is. And we know from our perspective how it affects us as a curator, what we're now able to offer that nobody else like is or has. We have all the relationships to like really hit the market with it, which is fun. I'd love to hear from your perspective who you see as winners and losers from this transition and how it will affect business coming on chain as well as current on chain, protocols and liquidity.
Very difficult to pick winners and losers. I do think that we can talk very much about the people that will be more close to this solution. I do think that the reputable, interested asset issuer are going to be probably the biggest winners here, because what we are providing at zero code changes for them, at completely like baked into the RedStone feeds, is a way to solve the adoption friction that they have, and the utilization and the liquidity friction that they have. But I would not consider them to be the only winners. At the end of the day, if I am an investor in a specific asset and that asset can give me instant liquidity where, instant liquidity normally is not possible, I'm also a winner. The curator is also a winner because you reduce the risk of bad debt significantly by having something like this. So to me, the winner is really the industry, right? So we're getting closer to where we want to be, which is we want to be in a world where there's no TradFi and DeFi, there's just Fi, right? And now this is another building block. It's not going to get us all the way there. No single thing is going to get us all the way there, but this gets us a little bit more of the way there. In terms of losers, I see very little downside to this, to be honest, when it comes to going to lose out of having something like this available. I do think that is going to solve some of the issue that, for example, Bryan was talking about. So for RWA asset, they're just effectively a little bit of a front for not a lot of liquidity or real liquidity. Then eventually this is going to affect them, not in a positive way. But for the industry, even that is a good thing because you start to select what are the reputable, more secure, more stable RWAs that can be on chain and then can power this new Fi compared to the other ones that they cannot. So I do think that overall for the industry is a good thing, and this will also hopefully make it a bit more reliable and more risk.
Yeah, I'll add that yes, this is going to make the industry a lot bigger, and so even things or groups that might be considered losers, I think will nominally win. So my expectation is that the unlock of RWAs and more TradFi assets coming in, doing more in lending positions, more. We just got off a call today with a very large traditional lender, and they're looking to start tokenizing some of their positions because then it grows their scale, their size by being able to decentralize their positions. Exactly the kind of stuff we're talking about here. As more of this takes place, I think that the market share of DEXs is going to continue to decrease. That said, a decrease in market share in an exponentially growing market will probably lead to still nominal increase, just significantly slower compared to everything else. So yeah, I agree. The whole industry wins, rising tides, raise all boats type thing. And I agree that this is going to be a very key piece that unlocks finance rather than what has been DeFi. It's not even as much of a mullet anymore. We started calling it internally just on-chain finance. Yeah, this is gonna be fun, man. We're excited internally. We've been toying with what kind of LTVs we can offer now, and we're gonna be coming out very soon with industry-leading high LTVs that are actually the safest markets that exist, just because of this massive unlock. So it's been a pleasure working with you guys on it.
Yeah, I think what you're, you talk about a loser in this. And I don't think there's an explicit loser. There's just people with different time premiums, right? There's people that are going to be okay, prefer to have it at zero, right? Instant liquidity at zero. And then some people will be like, cool, we can manage the risk on T7. And to manage the risk and be able to handle the risk at T7, it's I'm going to put in this vault. I'm going to get all the returns back and be able to clear all this debt in T7. And I'm going to get a time premium, I'm going to get a rate premium, and I'm going to be able to get yield on that. And I think we're just people with different risk levels and different time duration appetites. There's some time duration appetites that are wait a second, I can only, exit my fund once a year. And I have to have a 60-day, a 30-day window once a year where I can exit. Some of these funds are insane. You only get to choose once a year. You have to do it exactly, 60 to 45 days before the exit period. It gets people to tap out. Yeah, Eric, what else do you have about time?
I'm curious, as things get faster, as we get faster blockchains, more real-time blockchains coming out, AI's making exploits a lot faster. What are you seeing as far as timelines of feeds and oracles that is the definition of real-time going to change? Are we going to lose out on something if we stick with 400 millisecond times? Do we need to get to 50 or 20 millisecond times? You guys are doing 20 right now with one of your protocols, right? Bolt?
We have a product that's called RedStone Bolt that is our fastest oracle, the fastest oracle in the market, as a matter of fact. And that is an extremely, extremely fast oracle. That said, as you correctly pointed out, it's needed in some cases. Like, I will not recommend people to get, RedStone Bolt or like such an equivalent fast oracle everywhere for every use case on any chain. There are certain cases in which you need, 10 millisecond update time, and there are certain cases in which, 1 second or 2 seconds is a completely reasonable thing because maybe the block time is longer than that, right? So having 10 milliseconds on Ethereum mainnet will not make a lot of sense, right? Because you're just gonna not utilize it to the fullest. So I do like Bryan's perspective on this, and I think that it applies also here. It's a matter of giving options and trying to fulfill the gaps for the different use cases as best as possible. So yes, we do have the extremely fast Oracle with Bolt. We have very extremely fast feed with HIP3, but we also have our pool model when it comes to like people actually pulling data directly from RedStone. We have different push times on different chains. Now with Settle, we're offering this opportunity for people to just have instant liquidity at a percentage of discount when they need it. It doesn't need to be every single market on every single RWA in any single use case, but it's definitely something that is needed. So this is a little bit of what the philosophy here is. Instead of imposing a specific direction to DeFi and just saying, okay, now everyone needs to get 10 milliseconds Oracle because that's just the way that it needs to be. What we want to do is try to fill the gaps that we see in the industry to make DeFi a more reliable and a better place, and eventually remove, as we were saying, like the DeFi, the D from the DeFi, and just keep that as the on-chain finance that powers both traditional finance and decentralized finance.
Completely agree. The time premium thing, it's like yield and time and risk. I mean, like, it's like the combination of these three things are just being able to pull it apart and tease it apart. I mean, like, a lot of the things in crypto, like you have the same dev that's doing the risk curation, that's doing the time duration. And now we have to like, okay, it's too much for a human brain to handle. Like the systems in place, we have to kind of like start to rip apart, which maybe like one or two people did at a protocol, like to like all these things so that it is professional, is sustainable, and is maintainable at scale. And happy to work with you guys. Mike, if people want to reach you, learn more about these products and get involved, what's the best way to reach you?
So before that, we're very happy to work with you guys too.
Yeah.
It's been a very good ride together. I am very glad that you were among the first, if not the first people that we talk about, for example, Settle with. And the relationship that we have with Alpha Growth, we really value it. And it's very important for us. And like, we like to work with you. We've been, as you said, talking about Atom back in the day, 1 year and a month, I think, pretty much now ago. And we've been working together ever since. And I love to see the evolution. I love to see what you guys are doing. It's and I'm not saying this just because I'm in the podcast. You guys know me well enough to know that this is true and coming from the heart. So yeah, thank you for having me.
Absolutely.
And very, very happy to work together and keep working together. That said, if people want to reach us, RedStone.finance is definitely the best place to get all of our contact, is our official website. There is, I can probably tell you, like a new look that is coming to the website soon enough. So that will include a bit more of what we talked about. So now we hold off a little bit to send some updates to the website in the front end on this new product and these new features, because we've been working on a redesign that's coming. Also, Twitter, it's very, very important. Just today, we posted an interesting case study between Credora and Spark that is very fascinating on seeing like how effectively risk can impact investment into different protocols and into different vaults. So all of the latest news, they're on Twitter. And as per usual, my Telegram is just my name. So feel free to reach out. And if you want to talk about Settle, if you want to talk about the industry, if you want to talk about oracles or anything interesting at all, I'm always open to a conversation.
Settle is an awesome product, awesome idea, and it's time to let's put our BD muscles to work and let's get these funds in there, right? Mike, thanks for coming. Always a pleasure, dude. This has been a dose of alpha. You can catch it on your favorite channels, and we'll put it on Twitter. We'll put it on YouTube. I think we put it on Spotify as well. Awesome, guys. Thanks again for joining A Dose of Alpha.
Thank you, Bryan. Thank you, Eric.
Thank you, sir.